So why is valuation important? Valuation is important to both founders and investors. And as a founder, you need to understand what the investor's objectives are. The investor actually wants to make 3 to 4 to 5x their money on their entire portfolio of investing. That doesn't mean that each of the companies in their portfolio have to make 3 to 5x. What it means is that each of the companies in the portfolio have to make between 30 and 50x to make up for the fact that 3/4 of the companies are going to fail. And that's not your fault as a founder, and it's not your fault as an investor. Everybody's doing their best to make sure every single company in their portfolio returns 30 to 50x, or if we could be sure that they all would succeed, we would only need to return 3 to 5x. Why is the 3 to 5x number so important? Well, really, it comes down to the stock market. Most people can put their money into an index fund in the stock market, and with 100 years of history, we know with a great degree of certainty that you can make 2 times your money in somewhere between 8 and 9 years. For the extra risk you're taking in investing in startups, knowing that 3/4 of them are going to fail, you better make 3 to 5x return on your portfolio of startups. Otherwise, it's just not worth doing. So when you're setting your valuation or your valuation cap, when you're proposing that to investors, it's really important to know that they're going to be looking at this investment to make 30 to 50x when they consider their entire portfolio. So in order to get to 30 or 50x, what you want to do is make sure you're in a big enough market and you're solving an important enough problem to get there. You're also going to want to make sure that companies that are getting acquired or going public in your market, although you're probably going to be acquired rather than going public, can actually generate enough revenue and have enough of a multiple on your revenue to actually be acquired and make those kinds of returns for you as a founder and for those people who are investing in your company. So we've created a tool that will help you to determine if you've created an offer, a proposal to investors that can make them the 30 to 50x types of returns that they're going to be looking for. So don't think of this as investors being greedy bastards. They may be, but if an investor is investing in 15 to 20 to 25 companies, which most investors do, each of those companies in that portfolio of investments must be capable of making at least a 30x investment, probably as high as a 50x investment, especially if they're investing at a pre-seed or seed level investment. If you are seeking investment at the A round or a B round or something that's beyond the pre-seed and seed level, well, your returns can be a little bit smaller because the risk is lower and the timeline is also lower. But if you're in a pre-seed or seed level investment, the timeline is going to be probably at least 8 years, might be a little closer to 12 years. So being able to return 3 to 5x on the portfolio is important. And the only way to get there is to have each one of the companies in the portfolio capable of returning 10 times that amount, or 30 to 50x. Now, let's go take a look at the tool, try to figure out what all this means and how you can calculate what your offer is likely to generate for your investor.